Very welcome, everyone. My name is Nicholas Tan from Kenanga Futures, Sudan Berhad. Thank you for spending your precious time to join our webinar today. It's a joint collaboration with CME Group in our effort to create awareness and provide education on listed derivatives to the participants. So we have returned with our nationwide campaign. It's called Accelerate into the Futures. Stand a chance to win prizes worth up to 50,000 ringgit and when you trade Malaysian and also US futures contract from 2nd August until 29th of October this year. To learn more, please visit Kenanga Futures website at www.kenangafutures.com.my. Please take note that futures and options trading involves substantial risk due to leverage factor and may not be suitable for investors. This webinar is purely for education purposes. Kenanga Futures Sudan Berhad accepts no liability whatsoever for any direct or consequential loss arising from any use of the content of this webinar. So before we start, we would like to take this opportunity to invite you to Kenanga Futures' next webinar on 29th September. It's about bull and bear riding the next big wave for WTI crude oil. Don't miss out, save your date now and get yourself registered. Also, if you have any questions along the session for today, please feel free to drop your questions at the Q&A box on the right side of the screen. Today, we have Mr. Daniel here, and he's going to share with us about 2021 quarter, the last quarter on market outlook on US indices. Without further delay, I would like to kickstart our webinar by welcoming our speaker today, Daniel. Over to you.
Hi, good evening, everyone. And time has actually fly, and we are already in September. And for that matter, we are already in the middle of September. So September has always been a month in which equities has always been known to be majority weak. Okay, so last week we saw some late sell-off in US equities. However, the first 2 days of this week, we have not seen the follow-through. But however, I think the sentiment is a little bit soft going forward. So it'll be quite interesting time to talk about equities futures and equity index futures for that matter. Okay, now I'd like to share with you my screen. Now, if you can see this, that'll be great. This will be the topic of today's webinar. We'll be talking about the second half of 2021. Actually, we are already in the third quarter of this year. Okay. Now, like I said, okay, Nicholas has already mentioned, this is something that we have to cover as well. Trading of any kind of leverage products, especially futures and options, do carry risk. So please do understand your own risk profile and your risk appetite before attempting to trade any of these leverage products. And common sense dictate that you do not invest more than you can afford to lose. And of course, the opinion that I'm going to share with you today will be all my own. And it has got nothing to do with either Kenanga, CME, or my company, Traders Academy International Private Limited. And you should not hold my officers and shareholders liable. So this presentation will be strictly for education purposes only and should not be construed as financial advice. Now, let me get straight into the topic itself. Now, we all know that the US equity has been an amazing run since the depth of the last financial crisis back in 2008, 2009. And there was a pause in between. And of course, we all know as we enter the 2020 last year, the first quarter, we witnessed a massive sell-off in US equities on the back of the pandemic. And since then, the low was traded in March of last year. And since then, the market has been charting into new territories on the back of many factors, which we're going to be discussing today. Okay, so the key question on everybody's mind is what is going to happen next? Of course, the main question is what is causing US equities to be trading at such elevated prices at the way it is right now? And of course, we're going to be talking about the impacts of monetary as well as fiscal policies. And very briefly, because we only have limited time, I will not be going into depth. Okay. Now, the first thing we want to know would be the Fed fund rates. What is actually a Fed fund rate? A Fed fund rate is actually the target interest rate set by the FOMC, which means it's the Federal Open Market Committee, which we're going to have another one next week. Okay. So the next week, FOMC meeting is going to be very crucial because everybody will be looking at what the Federal Reserve Chairman is going to tell us. Is he going to start talking about a timeline for tapering? obviously we can rule out the fact that he's going to do anything on the interest rate fronts, because he has already told us many times that he will, the Federal Reserve will not be looking at hiking interest rate until 2023. So the only thing left on the table will be tapering. Is he going to taper? If he's going to taper, when he's going to taper, by how much? So that would be the main interest for next week. Okay, and of course, the Fed fund rate do influence markets, because people look at the cost of borrowing, because the Fed fund rate actually becomes the benchmark rates for setting all commercial rates, whether it's credit card loans, whether it's mortgage loans, car loans, every kind of loans will be based on the Fed fund rates. Currently, the Fed fund rate is almost zero. Okay, it's at 0.09% as of yesterday. Okay, so you can see that the Fed fund rate is at record low right now. Okay, so do keep an eye on this. Low rates is actually good for equities, because if you keep the cost of borrowing low, then people can go around with their commercial activities. In particular, stock market love low interest rate environment, and it looks like we're going to have an ultra low interest rate environment for some time to come. Okay. Now, the first act when President Biden became the new president at the beginning of the year is to sign a bunch of executive orders, and one of which is the stimulus package that he actually enacted in the first few days of his presidency. Okay, that amounts to $1.9 trillion. These days, billions is not going to do the job. We have noticed that the new administration has been launching trillions and trillions worth of economic packages, and right now in the act is, of course, a couple of trillions new packages that is going to go through Congress. Not yet cast in stone yet, because I think they're going to have a hard fight over this. Now, on August 10th, which is last month, okay, we can see that the Senate actually passed a bipartisan infrastructure package. Now, this particular plan is to rebuild. Okay, they noticed that they have been neglecting building infrastructure. Anybody who have been to the States will have noticed the rundown state of their highways, their metro systems, so everything is falling apart. So this infrastructure plan actually want to address this. Okay, so this one is already approved. However, the Democrats, which control both the House of Representatives and the Senate, now want to play hardball and say now this bill will not be pushed through unless they also accept another $3.5 trillion worth of social packages. And this is going to be a hard fight. And for some reason, I think they will push it through, because there's this thing called the reconciliation motion, whereby they simply pass by a simple majority. Okay, so I think the Republican doesn't want to have anything to do with the $3.5 trillion social program. Okay, because if it fails, it will fall on the laps of the Democrats, and can always blame them. Okay, right now the US is actually very divisive. You can see the politics is toxic, even among themselves, and not to talk about the rest of the world. Okay, so the other thing that we want to need to also talk about quickly is, of course, the Federal Reserve balance sheet. Ever since the first financial crisis in 2009, you can see that the Federal Reserve balance sheet in terms of money supply has actually pumped higher. Okay, from under $1 trillion, it has gone to above $2 trillion. Okay, and now it is at 8.36 trillion. This is as of last Friday. So you can see that the amount of money supply, when you talk about money supply, we talk about M1, M2, but the one that most people will not notice will be M0. Okay, this is the amount of money, including cash, including coins, paper currencies, circulating within the US economy. So the amount now is $8.36 trillion. Now, if you can only imagine, the Federal Reserve only have a budget, or rather a capital base of $39 billion, but they have a balance sheet of more than $8 trillion. This is more than 200:1 leverage. So the Federal Reserve right now is heavily leveraged, and I don't think they can climb down the horse. Not the horse, actually this is a tiger. Okay, they cannot afford to not to have this, because right now President Biden is already talking about spending trillions and trillions of dollars. So they're going to make the money available for all this expenditure. So of course, this will also link to the fact that the US may not be able to borrow past this month, because they already hit the ceiling at the end of last month. And Treasury Secretary Janet Yellen, who was previously the Fed chairperson already warned numerous times that if they don't deal, or rather Congress do not deal with this debt ceiling, either by raising the limit or by suspending it altogether, which what Trump has done previously, then come at the end of this month, the Treasury may not be able to do all this creative accounting in which to keep the US government going. It means to say they cannot borrow anymore, okay? So this will be having a negative impact going forward. Now, of course, earlier on, I did mention after pushing through the $1.2 trillion worth of bipartisan infrastructure plan, the one that is going to be tied together with this particular bill will be another $3.5 trillion. This will be social spending. You know, you can see the list of things that they want to do. They want to spend on rebuilding the American families, you know, giving free public education, for example, you know, and many stuff they need to do. And the bill came out to $3.5 trillion. Somehow they will have to find some way to push it through. If this bill cannot be pushed through, then I think the market will sell off. Okay, so because they have built up their expectation, saying that they will find ways to push this bill through. And if it's pushed through, then the next question is, how are they going to pay for it? Apparently, they are planning. I think just moments ago when I just briefly saw the headline, I think the Democrats has already released their tax plan as to how they're going to pay for this $3.5 trillion worth of social program. Okay, basically it boils down to taxing the rich and taxing the corporation, and that will have long implication, because if you tax too high, private enterprise is not going to produce. Okay, they will rather not produce, because what's the point? Okay, you take away the incentive of capitalism, right? So if the taxation is exceedingly high, something have to give. Okay, and I don't think it's going to be a good news. Now, the other thing is, of course, the biggest elephant in the room. We have been talking about US inflation since March. For the last 6 months at least, okay, last 5 months at least, okay, we can see that US inflation has been climbing. Now, if you have noticed the uncanniness of the timing, Joe Biden was came into power in February, and immediately the month after, because like I said earlier on, his first act was to sign executive orders in the trillions of dollars and to get the economy going. Okay, essentially to make sure that people who cannot pay rent are able to forego rent for some time, and that program ends last week. Okay, so going forward, we're going to see a lot of people will be having some housing issue, because you cannot not allow the landlord to collect rent, because the landlord has to pay mortgages. Okay, and if they don't pay mortgage, or they can't pay mortgages because they can't collect rent, then the banks will be impacted, because the mortgage loan is going to go bad. Okay, so there will be knock-on effects. So we will be looking into the next few months, okay, especially how the US consumer is dealing with the fact that a lot of people can't pay rent, and all the support they're supposed to get during the last 6 months have all ended. Okay, they're not going to get extra unemployment benefit coming into the mailbox anymore. Okay, so you can see that by and large, we're going to see a lot of things happening, but the main thing will be inflation. Jay Powell, which is the Fed chairman, has been he has been quite consistent. He has been saying that, look, this inflation that we are seeing is temporary, because we're coming from a very low base after a very quick recession last year. Now the numbers are high because people have this pent-up demand, and when you look at the numbers, you got to worry. Now on this chart here, you can see that there is a histogram in blue. That one up to that is a CPI number, which is 5.4%. And you can see 5.4% is very, very high. This is a 2-year record of the inflation picture over in the States. You can see that 5.4% for 2 months in a row. For the month of July and for August, it has been at the highest point. Okay, the one that we want to watch is the PPI. The PPI is the input cost of all manufacturers. Okay, so if the raw material costs more, it will reflect in the PPI, which is the producer price index. That one is at 8.3%. There's a lot of factors why PPI is so high. Of course, we know that the global supply chain has been massively disrupted. If you can check the freight forwarding charges from goods coming in from China to either the East Coast or West Coast of America, you can see freight charges has gone through the roof because it is no longer profitable to run. Used to be the freight charges used to be slightly over $1,000, okay, for to ship those finished goods from China to the States. And now it seems that China is still by and large back to normal. Their factories are operating, and however, those things that they are shipped to America, they no longer have to worry about price, because it seems that the US cannot get their products for anywhere else other than China. So China is going to stick to them the high input cost. We all know that iron ore prices, copper prices has all gone up very, very high. And China, being the producer, they take all these raw materials, they produce into finished products, they ship it all over the world, including the United States, and they are passing on the higher cost of input. Okay, so the US actually shot themselves in the foot by having a tariff war with China, because now the tariff add on to the higher input cost that the Chinese is selling to them. And on top of that, the Chinese have decided at this particular point in time to allow the RMB to be strengthened. Okay, so now it's not one, not two, but a triple whammy. Okay, whereby you have high import costs, and then China is passing on the higher cost to them, as well as when priced in dollar. Okay, the US has to use more dollar to purchase the same item from China, because the exchange rate is currently not in their favor. Okay, so all this is building up into very high PPI numbers, and this, I believe, is here to stay, despite what the Fed chairman has been telling us. The narrative that he has been pushing, I think, is he cannot say anything else, because at the end of the day, the last thing he wants is to create a panic. Okay, so this is what he has been towing the line so far. He said this effects, which is inflation, is now he actually recognized. A few months ago, he said, no, this is going to go away. But now it seems that CPI has been elevated for the last 2-3 months. And now he says, yes, now we recognize that it's a lot higher than we expected. And he still say that it's going to go away. Okay, so he has been very consistent in that on that front. Okay, now, of course, we all know that last month, there is a Jackson Hole Economic Policy Symposium, which they have basically is a event organized by the Fed of Kansas, whereby the Federal Reserve Branch of Kansas, in which they will gather academia, reporters, journalists, of course, policymakers, and then a powwow for over 2-3 days. And then at the end of the day, people will be looking at what is the conclusion. Are they going to do anything to tackle the persistent inflation that we are seeing? Now, the word come out from Jay Powell is that, yes, they are looking to do something on the asset purchase, meaning to say QE. Right now, the Federal Reserve is committed to buy securities in terms of U.S. securities, treasuries, as well as mortgage-backed securities, what we call MBS, to the tune of $120 billion a month. He says that, okay, eventually will be a taper, in the sense that he will maybe do something when he sees that the inflation is still persistent. So a lot of people were saying that, okay, now that you said that you're going to look into it, when are you going to do it? By how much? $120 billion a month. How much are you going to reduce your purchase of all these securities is what the market is looking at. Okay, if at the end of the day they do nothing, okay, and come out with only comforting words, then I think the market will not be buying this narrative for very long. Okay, we have to watch how this thing pan out. The other thing that we want to watch, of course, is the unemployment rates, which has been doing very well. They managed to bring down the amount of people who are unemployed in the States, but that masks the fact that at least more than 9 million Americans are still out of job compared to February of last year, which is just before the pandemic hit. Okay, so they are still missing 8 million jobs. And right now, companies, especially in the service sectors, are having problem finding workers. Okay, they cannot find workers to work, and they have to pay slightly higher wages right now, and that will again add into the inflation picture. Okay, so from every angle you look at it, it is nonsensical not to acknowledge the fact that the inflation is already here. Now, in a sense, I'm very glad that Jay Powell is not a trader, because when he look at the numbers, he know the trend is in place. And when we see numbers like this, we know this is a trend. The trend is trending higher. I'm talking about the inflation numbers here, and either he has the head buried in the sand, or he's trying to ignore the issue, hoping that you'll go away somehow. Okay, right now we have this issue, and I hope you do not buy the narrative that inflation is going to be temporary. Okay, I do not believe it for one. Now, the non-farm payroll is the last number that we had at the last week. Was it last week? No, the week before last. We all know the non-farm payroll was a disaster. Okay, they were expecting somewhere nearer to the last two numbers. Last two numbers has been fantastic. It was almost 900,000 new jobs were created for the month of June and July. August, they expected something like 725. The number came out was the disaster. It was 235. Okay, now imagine we are already past summertime. Okay, summer is the best time to create jobs, and now we are entering with autumn. Soon we'll be in winter, and jobs will be hard to come by. Okay, so we will have to take this into notice that it seems that the number of people being employed right now are mostly in the service sector, and you need manufacturing jobs. Honestly, in order to maintain or keep the unemployment rate down, you need some quality jobs. Okay, the quality jobs are all in manufacturing, and right now there's a shortage of microchips. Manufacturing cannot move forward. You see, the cars manufacturers have to suspend their line of production because they run out of chips. Okay, so those jobs that can actually make a difference are not coming back in a big way. Okay, so the one that's been suffering right now is the number that we are seeing right now are mostly for the service sector. Now, next week is going to be crucial, because after the Jackson Hole Symposium, we want to see that what the Federal Reserve is going to say right now. Okay, because they already said one of the criteria, they say they will do something on the asset purchases is for full employment. Now, what is full employment? If you have studied economics, full employment typically will mean 3% unemployment rate. Okay, for practical purpose, I think you should at least look at 4% unemployment rate before you can declare that you have full employment in the economy. So if the US do not reach full employment, that will be the next excuse not to taper. Okay, so we want to see what comes out of this FOMC meeting, which is scheduled on the 22nd of which is next week, basically. Okay, so do watch out. It happens always in the early morning at 2 o'clock Singapore time and your time. Okay, in the morning, so you may want to stay up and watch the how this event pan out. The market will be volatile in the immediate release of this communique. Okay, of course, going into the FOMC, market will be very, very quiet. Okay, another thing we want to talk about, okay, we have not even hit the main topic yet. Okay, now the US national debt. Now, of course, the US national debt has already hit the ceiling last month at the end of August 31st. Okay, I mean to say that currently the US national debt is at $28.5 trillion. Okay, and they cannot borrow anymore. Okay, for one. So what the US Treasury, Janet Yellen, has been doing is basically juggling, claw back all those budget that has been approved but not spent, and but she has openly said just last week that she cannot hold the line much longer. She wants both parties, whether including the Republican and the Democrats, to come together to either raise the ceiling or to suspend it, because they say if not, the US Treasury will not be able to issue new Treasury bills. They cannot finance, they cannot pay the interest on those treasuries that are due, they are maturing, for example. So if that happens, then the US will technically go into default. Okay, and that will have an impact. Okay, so far they have always managed to raise the ceiling, but now that the debt is so high, I do not know how much they can raise it to, because very soon after they raise, I'm sure it will be hit again. Okay, so most likely they will suspend it, do nothing, okay, and then let the next generation deal with the problem. Okay, now this is Janet Yellen. She said US is on track to default in October. At the end of this month, if there is still no resolution on this national debt ceiling, she is very afraid that something like this will happen. Okay, so right now both Democrats and Republicans are playing chicken, and this is how they deal with problems. Okay, now US Treasury yields. Now, if you are trading, you want to know why the Treasury yields, because the 10-year Treasury has always been the barometer in which to decide, okay, if the yield means the amount of returns you have to pay for buying US securities, for this instance will be the 10-year Treasury, then the yields will be something that people want to watch, okay? A rising yield is definitely not good for equities. If, for example, the US started to hike interest rate, okay, that is of course no good for equities. So US Treasury is actually competing with equities, because this one is a risk-off. Treasury is actually what we call a risk-free kind of instrument, whereby, you know, there is hardly any risk involved, because backing the US Treasury will be the US government, compared to equities, which is a risk asset. So if the yields are better in a risk-free instrument like a Treasury yield, more people will be willing to park money in US Treasury rather than take their chances in US equities. Okay, anyway, the US equities are already at very high valuation. Many people are saying that the valuations are already overvalued. Okay, so you have to watch out for the rising signs of rising yield. Okay, right now it's at 1.33 up to yesterday. Okay. Now, this is where I think you guys will be here for, to listen to what I think will happen to US equities. We're going to concentrate on the 4 major equities here. We will talk about the S&P 500, we'll talk about the Nasdaq, we will talk about the Russell 2000, as well as the Dow Jones, okay? Now, I have given you this based on the monthly time frame. Okay, I think it's very important for all of you, when we look at US equity index, we must always look at the cash index. And the cash index will actually be the one, because it have to be based on something, right? Okay, because at the end of the day, the futures contract is a derivative of the cash index. Okay, so S&P 500, you always want to start off by looking at the longest possible time frame you can. Okay, most trading platforms only give you the ability to look at the monthly time frame. But if you really want to spend time looking at the historical pattern of US equities, and US equity has been around, has recorded history for very long time, okay, more than 100 years. So there's a lot of historical data. Even if you look at the yearly time frame, you will find that there will be insight you can see. Now, the constraint we have is, of course, for most trading platforms, we can only see the monthly time frame. So the way I see it, okay, you'll see that there are a couple of boxes set in green. The way I see trends, okay, I need to know whether the market underlying trend is up or down. Of course, we all know US equity at record high, definitely the trend is up. But I need to see where the contest for dominance is being fought. Okay, you can see that the low on this year will be the low in 2009, which is when they started to do QE. Okay, the first round of QE, QE1, QE2, QE3, that caused the market to actually surge. Okay, the bottom was at 666.79. This is the S&P 500 index itself. This is the cash index, and of course, last year in March, we have a low of 2,191. That was a low in March last year, and they launched not only they bring interest rate down to almost zero. They launch QE, and on top of that, it doesn't seem to work. They bring out the fiscal policy in which they launch trillions and trillions of stimulus package. So this is where we are right now. Dow Jones high so far, okay, this month, okay, it's at 4,545. This is the record high, okay? But you can see from the monthly time frame, the target for this is actually 6,000, okay? So we are not done with this bull run yet, okay? So this is the larger picture. So if we have a correction, if there's going to be a correction, then you must understand, unless the index goes below 2,100, this bull market is still very much alive, okay? So what I'm trying to say is that if there's going to be a massive pullback, it is still a buying opportunity. Okay, how long it will take to rise again, that will be another question. But by and large, this bull run is still very much alive, even if we have a very steep correction. Okay. Now this is the weekly time frame. Now if you see in this weekly time frame, of course this is a zoom in of the period from last March low of 2,191. The current high is 4,445. Okay, you can see that there are two channels, very neat, okay, in which price has been trading. Okay, so you can see the one in purple, that one is 45 degrees. A 45 degrees channel is very, very stable. Okay, you can see that right now we are nearer the top of the range. Last week we have the first inking of maybe some profit taking coming in. Okay, because you can see last week, especially on Friday itself, the market actually closed on a weak note on the weekly basis. It practically closed at the low of the week. Okay, so far this week we will see some kind of rebound, but I think going forward there is a risk that we may see further downside. Now within this purple channel, you can see that there's another blue up channel. Now this up channel is a lot tighter. The gradient is a bit steeper than the one at 45 degrees, and this one is the first sign of maybe persistent profit taking will be the break of this blue channel. Okay, so look out for this, and this is based on the weekly time frame. Now on the daily itself, now I go back to the micro E-mini S&P 500. This is the December contract. For those who are still trading the micro E-minis equity index, do remember the contract expires this week. You want to start rolling over to the next contract month, which is December. So as of last night, the market closed at 4,468, and you can see on this particular chart that there's not only a green color box, there's also a pink color box. Now the pink color box is telling me that is the counter trend. The underlying trend is still very, very, very bullish. However, we are getting a counter trend to the downside, and technically this counter trend is still in development. It has not officially turned into a counter trend yet, but it looks like it's going to be the case, because all I need is another day of not challenging the low of, let's say, the day before yesterday, okay, which is on Monday. So if we do not have a new low lower than Monday's low price, I think we're going to get the counter trend in place. Okay, now if the price can go back to 4,536 area to 4,550, that area is an area of interest for me. Okay, if price can go back to those areas, I will be very interested to do counter trend by selling. Okay, and my stop doesn't need to be very, very far. It just had to be just above 4,550 points. Okay, so you can see that this will be my outlook. And then you must also notice that on the bottom there's a volume array whereby you can see green and pink color bars. Those are the volume, and the volume has not been fantastic. Okay, so far. We need to see very high volume. For example, at the beginning here of this channel, of this blue channel, you can see the spike up in volume. If we see a volume like this accompanied with a sell-off, that will be your signal that the market has confirmation. Okay. Now this is the Nasdaq Composite Index. Again, you can see the low traded in 2009 was 1,265. Currently, the market high is at 15,400. That is sevenfold. That means the market has gone up sevenfold. It's crazy, isn't it? So you can see that this market is really charging away. Okay, the sevenfold refer to the low of 6,190 to 15,403. Okay, you can see that this is a massive bull run, and the projected target is at 21,000. Okay, so we still have a lot of room. Again, even if we have a massive drawdown, unless the price, the index itself goes below 6,190, I am still bullish on this market. Okay, in the daily time frame, this is the weekly time frame. You also have a channel. So most of the index that you see are basically, they are quite similar. Okay, but as we go down to the next index, you'll find that there's a slight difference going forward. Okay, but for the time being, you can see that the Nasdaq and the S&P 500 actually are trading within a very, very neat channel. Okay, obviously down the channel, if you divide the channel into two halves, we are now at the bottom half of the channel. Okay, you can see that there's a midpoint within the purple channel. Okay, and you can see that the price are hugging the low end of this channel. Okay, although it's still rising, the projected target on the weekly time frame is at 18,837. Now this target are not cast in stone. This is a target for me to at least know, is it worth my while to chase? If I want to chase, what are the potential, and relative to where I think if I need to get out in a hurry, where's the point I need to get out? So those targets are just for me to know what are the potential of, if I continue to buy at this current price. Okay. So in the daily time frame, this is the micro E-mini Nasdaq 100 now. This is not the Nasdaq Composite Index. This is the Nasdaq 100. Okay. Again, currently the active month is soon to be active month will be December. The last traded price yesterday was 16,436. You see, unlike the S&P 500 and Nasdaq S&P 500, they actually closed on the downside. Okay. Earlier on the daily time frame, you can see that the S&P, the December contract actually closed higher yesterday, but for the Nasdaq, it actually closed lower. So we are beginning to see some kind of divergence going on. Okay, on the daily time frame, we can also see that there's a blue channel. The market has been trading within this channel since the middle of May this year. Okay, so for the last 3 over months, you can see the market has been trading within this very neat rising channel. Now, the other one I want to bring your attention to is, of course, the indicator at the bottom. That is the RSI. Now, RSI, if for those who have been trading technical indicators, you'll know the RSI is the relative strength index. Now, you notice that price has been going up. However, the high within the 2 peaks in the most recent 2 peaks in the RSI, okay, one in July and one is in September. You can see that the peaks are getting lower. So this is a classic divergence. And when you have price and the indicators not moving in the same direction, then that is a sign that the market is likely to topple over. Okay, when I say topple over, I do not mean a waterfall crash. Okay, I think we are more likely to see first, okay, a pullback. Okay, so at its current price, market seems to be wanting to come down first before you do anything else. So a lot will depend on, maybe we need a catalyst for market to move down. Okay, either the national debt deadline comes this month, nothing happened, and then go into the 1st of October, and then the US Treasury cannot borrow anymore, the US government going to default. That could be one catalyst. The other catalyst, of course, will be nearer, which is next week. On the FOMC front, we want to know what Jay Powell is going to tell us, especially in regards to tapering, in terms of timeline and the quantum. If they want to cut, how much they want to cut from the $120 billion they are buying every single month. Okay, so you can see that typically, if you have also done some kind of wave analysis, a divergence is something that you always see on the 5th wave. When you have a 5th wave, either up or down, and the indicators is showing divergence, it is always a dead giveaway. So on a comparative basis, I think the Nasdaq is looking toppish right now. Russell 2000 is a small cap index, okay? Refers to 2,000 stocks for companies that probably you and me have not heard of before, okay? So these are the mass market. And you can see that in this particular chart, this is the monthly time frame. If you notice, the S&P 500 and the Nasdaq on a monthly time frame do not have a counter trend. However, we already seen a counter trend in the Russell 2000. For the last 2 months, it has been trading counter trend. Okay. However, the price, the index has not toppled over yet. It is trading within a very, very confined range. Okay, upside target is 3,221. The last traded was 2,249. Okay, and this is where we are. We have a counter trend in place. So I am very, very interested to sell this thing. In fact, I already sold for the last month or so. Okay, I still haven't. It's still hovering above my upper sell, but my lower sell is actually still not showing profit, okay, because the market actually ran up last week, okay. But I'm holding on, and I hope to add on to this sales short position if the price can actually revisit the 2,331 levels to 2,360 levels, okay, and my stop will be just above the all-time high at 2,361, for example, okay. The target for this move, I'm not looking for a waterfall. I'm just looking for a market to actually retrace back to 1,950 levels. That will be for me to take profit for this particular position that I have. Okay, on the Russell Weekly, you can see that the consolidation is very, very well marked up. The bottom is at 2,100. The high traded is 2,330. Okay, so you can see that the range in which this market has been trading for the last 2 months has been within these two boundaries, 2,100, 2,330, okay? So but I think there's a very good candidate to say that this one is a lot weaker than even compared to the Nasdaq. Okay. On the weekly time frame, this is the micro E-mini Russell 2000 December contract. Closing price yesterday night was 2,231, and you can see the ranging is also symptomatic with the cash market. This is of course the futures contracts, and it's exhibiting the same thing. The low is at 2,100. You can see the first low was 2,090, the second low was 2,110, followed by 2,096, 2,106. You can see the 2001 has been practically holding the bottom. Okay, if this bottom give way, unless the price takes out 1,877, which is the low of this green color box here. If this level is taken out, then I think we are into something much bigger. Okay, so for a time being, the underlying trend is still bullish. Okay, the moment 1,877 is taken out on the downside, then the entire picture looks bearish to me. Okay, at least on the daily time frame. Now, this is the Dow Jones. This is the cash index. Dow Jones do not have a high so far this month. Okay, so it is again not showing the same symptom as the S&P 500 or even the Nasdaq. Of course, we know that the Russell has not have a new high for 2 months. Okay, for the Dow Jones, and this one it will be key because most of the fund managers, the money managers, they are looking at the Dow Jones. They're not looking at the Russell. They're not looking at the Nasdaq, for example. All the fund managers will be looking at the Dow Jones because this is the mother of all index, and they will have to benchmark their portfolio against this Dow Jones. Okay, so when this we call the money managers index. Okay, we want to watch how the smart money, so to say, is parking their money. And you can see so far this month, we're already in the middle of the month only. You can see we are seeing signs of market wanting to come off, or at least some kind of playing safe. They want to take some money off the table. They want to take some profit. Hopefully this does not lead to a cascade. Okay, but I think it has every reason to take profit because based on the sign the US economy is actually slowing down. By looking at the retail sales, by looking at the GDP, you can see that the next 2 quarters is not going to be very, very rosy. Okay, so on the weekly time frame, you can see that same thing. We're going to have there is a rising channel since May, and the market has been trading very neatly within this range. Again, you can see that on the daily time frame, on the weekly time frame, there is at this present moment no counter trend. The counter trend is visible in the monthly time frame, but however, you can see that because the high is just traded last 4 weeks ago. Okay, 4 weeks ago, we can see the high of 35,631. That was a high traded for the Dow Jones Cash Index. So far, we have not have a counter trend yet. But on the lower time frame, you can see there's one already. This is the daily time frame. Of course, this is the micro E-mini contract for the December delivery. Last night closed at 34,754. And you can see the market is trading at the lower band of the range. Okay, it'll be very interesting. I think there's a very good chance for the market to come off and test the 33,850. Okay, if that comes, then that will complete this one the first contest for a counter trend. Now, at the bottom of the chart there, you can see the same thing, the RSI. You can see that the period from May to the all-time high, which is in August, okay, the price has been going up. The index is not following through. So you can see the divergence is a lot more pronounced in the Dow Jones index, okay, on the daily time frame. So there you have it. Okay, these are my views, and I think you want to be a little bit cautious on the upside now. We are going into a terrible month next month. Okay, October has always been a terrible month for equities. Most of the major corrections, for some reason, always happen in October. I remember the first time I actually caught a market downdraft was back in October 1987. Okay, I was lucky. Okay, I didn't get caught on the wrong side, but I was selling the Hang Seng futures on the particular month back in 1987. That's so long ago. But I have noticed that every time the market goes into October, there's always a sense of nervousness. Okay, September is not going to be a good month for equities. Then we have a back-to-back on October, so you want to watch out. Okay, if you want to chase the market, wait for at least a decent correction. Okay. So let's talk about the E-mini micro E-mini equity index. Now, before I even talk about that, let me give you a little bit of a history of why we have such a product called a Micro E-mini. The first S&P, the first equity index was actually the S&P 500. Okay, when you talk to people about stock market, it's easy for people to give you an opinion. If you talk about the general market, if you ask them which particular stock go up, that would be a more difficult question, okay? But if you ask people, anybody in the street, is a market up or down? By referring to the general market, in this case, we talk about an index, for example, then it's a lot easier to grasp the concept of whether the market is up or down, okay? So the SME actually launched the first equity index futures back in 1982. I entered the business in 1985. I was trading the regular S&P 500 in the late 1990s, okay? And in those days, there is no E-mini yet. Okay, we were trading the regular contracts, and then subsequently, as the value of the index actually rise. Okay, now remember, if the index is at 100 point, and the notional value is only 50,000. Okay, now back into the early 2000, you can see that the index has already gone up to 50,000. Oh no, I'm sorry, to 3,000. To 3,000, the notional value is $150,000. Now, can you imagine you have to put up a margin based on 150,000 notional value? Okay, a lot of people will not be able to afford to participate in this equity index futures. So that's why they launched the E-mini. So where we are right now, okay, the S&P 500 is so much higher, and again they have to launch a new product to cater to the people like you and me, okay, so that we can actually afford to participate. Throughout the history of CME, the equity index futures has been the most successful. From day one, you know, the acceptance of equity index futures has always been there. So when they launched the Micro E-mini contract back in 2019, the market, you know, welcomed the move. Okay, now you can see the notional value based on the multiplier of 5, then it become much more affordable, because the notional value based on the new multiplier of 5 is only 20,000. Okay, so this is the big history. Now there are 4 major equity index futures you can trade on the CME. Okay, we have already gone through that. We have the S&P 500, the code name will be MES, Nasdaq 100 will be the MNQ, Russell 2000 will be the M2K, and then the Dow will be MYM. Okay, you can see that uniformly they are priced at 50 cents per point. Okay, for the S&P 500, the minimum point movement is a quarter point. Same for Nasdaq, and then for the Russell 2000 is 0.1, and then for the Dow will be 1 point. But they're all at 50 cents. And of course, the contract month will be every quarter: March, June, September, December. Okay, right now we are waiting for the market to open in about 9 minutes time. 8:30 the market opens. This is the regular trading hours. Of course, they also have Globex, which is the electronic trading hours. Then you don't have to worry about delivery, because they are all financially settled. Means if you hold a position until the last trading day, you will be either they credit you or they debit from your account. Okay, so this is a very easy way to do. The maintenance margin, last I checked yesterday, for the S&P 500 is just above $1,000, and the cheapest one, of course, would be the Russell 2000 at $650. So it's very, very affordable. Okay, meaning to say that you and I can easily use this contract to participate if you have a view of the index itself. Okay, now the volume traded. Now here we have we have 2 charts here. I'm showing you the first on the left will be the August 2021 volume, meaning to say that for the month of last month alone. Okay, you can see there are 3 color bar here, and you can see the legend at the bottom. The blue refers to the S&P 500. The Micro E-mini S&P 500 is at 13.6 million. That's for 1 month. So for 1 month, the volume traded for a product is in the millions. Can you imagine the kind of deep liquidity they have? Okay, the Nasdaq, of course, the champion right now is 16 million for the month of August, and the other 2, of course, lagging behind is the Russell 2000 as well as the Dow Jones. Like I said, the Dow Jones is traded mainly among the fund managers. They don't trade the micro. Okay, so it's quite logical for the Dow Jones, the Micro E-mini contract to be showing decidedly low volume traded. Okay. Then of course the other chart you can see on the right, which comprises of green bars. You can see that for the 4 different contracts. Okay, you can see up to yesterday. Is it up to yesterday? Up to yesterday, you can see the volume traded was 141.5 million accumulatively. Okay, and we are not even done with September yet, so we have another 3 more months to go. Okay, 2.5 months more to go before you see end of the year. So this number is going to get a lot higher. Okay, so you can see that the volume has been there, the liquidity is good. Now, one of the things that you want to know whether the product is tradable or not is by looking at the volume, because the volume, if it's high, actually brings down your total risk. Now, you can imagine if you want to buy or sell anything and the volume is not there, meaning that if you put a bid and there's no offer, and the only way for you to get into a market if you want to buy is to hit the offer, then you're giving away the spread, okay? And everything costs money, whether it's a commission or whether it's the real cost of trading, which is the spread between the buy and sell price, okay? All this will make it will make a difference, especially if you're a day trader. If you're a scalper, you don't want to give away too much of a advantage in terms of spread. So if the volume is high, the spread will be very, very tight because the market is very competitive. Okay, it means that you don't have to give up a lot of advantage by getting in and out of the markets. Okay, that is very, very important. Now, at the end of last month, you can see that CME announced that accumulatively all their micro futures has crossed the 1 billion contract traded. Isn't this amazing? Since their launch in 2019, you can see the micro E-mini equity index, which represent about 87% of all the micro contracts offered by CME, okay, has already crossed the 1 billion mark. So this is amazing, okay? So be assured that this is a very, very, very tradable contracts, okay? Now, of course, the key advantages will be it's very versatile, okay? Because right now you can not only deal with the E-mini contract, which is 10 times bigger than the micro E-mini, okay? It gives you a lot of strategies which you can actually use. Okay, the scalability is the other one. Previously, let's say you buy one or sell one E-mini contract. Okay, right now you can split it into 10 different portions. It allows you to scale in, scale out of the market. Now, if you want to understand what is scaling, it's like dollar averaging. Okay, instead of buying one contract of the E-mini at one price, now you can scale up the one E-mini into 10 different micro contracts and then scale it at different prices. So that gives you a lot of advantages. Okay, accessibility, of course, is understood because the margin required to trade the E-mini compared to, let's say, the micro E-mini is so much lower. Okay, so you want to compare whether you and I can actually access this product. Yes, we can. And obviously, it's going to be retail friendly. And I think that's one of the reasons why they roll out the micro E-mini, to make sure that the average Joe like you and me can actually participate in this product itself. Cost effective, of course. Later on, I'm very, very sure Nicholas is going to talk to you about the commission for trading the micro E-mini, which is so low. Okay, and it's a no-brainer. Now, you can always join me in my weekly webinar, which I do not charge. It's free to attend. You can see there's a link there. If you want, I can put up the link later in the chat box. Every month, every Sunday at 8 p.m., I do have a overview of everything that I watch. I watch everything. Okay, I watch equity index, I watch currencies, I watch precious metals, commodities like crude oil, and of course, cryptocurrency. So it's more than a 1 hour kind of a webinar in which I keep myself updated as well. So Sunday, if you want to come, this is the link. Now, you can always find out more about me by buying my book. Okay, my book is available at Kinokuniya, both in Malaysia and Singapore, and you can always buy them online. And if you need to reach out to me, these are the 2 ways you can find me. At my website at tradersacademyonline.com, or you can write to me at my email at support@tradersacademyonline.com. Okay, so yes. Now, this is the moment you're waiting for. If you've got any question, I will be taking questions from here onwards.
All right, Daniel, we have the questions here from Dennis asking, what is the best asset class to hedge US equity other than the VIX or the VXN? Also, when the US equity facing meltdown or liquidity rush, what's the impact to Asia stock?
Obviously, you have to understand when you trade equities, you cannot not monitor the US equity because they are the last market to close every single day. So they decide the closing price, and that will affect the opening price in Asia, the opening price in Europe. Okay, so if US is down tonight, tomorrow morning you can bet your last dollar the Asian equity is going to open gap down. Okay, so it will have a direct impact. So you do want to watch the US equity, because for anybody who trade equities, if you don't trade US equity, I think you're missing out on big time. Okay, especially if you're trading Singapore equity, I think it's a total waste of time because the volume is not there. It's just not exciting. Okay, maybe in Malaysia the pictures are a lot more different. Okay, but for Singapore, I think it's a total waste of time. Okay, if you're trading equities, then you should be looking at US equity because it's very, very deep in liquidity. It is very volatile, which is something that we want. We want to have volatility. And then imagine if the market is flatlining. Okay, then there's nothing to trade. Okay, so you want to watch US equities.
Okay. The next question followed by Dennis also is drop to from current month to month to 6,100 in Nasdaq is a huge drop. Is it possible? And almost 100% month to month drop to sit price.
I'm not saying that it will drop to those prices. I'm saying that if it violate those prices, then my view of the long-term trend will change from bullish to bearish. So that's why even if the market have a very, very steep correction, so long as this low point that I did mention earlier on are not violated, then the bullish trend is still very much intact. Okay, which is the same thing like last March. The market have a massive sell-off in a period of just 1 month, and everybody panicked. But it did not violate the long-term outlook of equities index back then. Okay, so right now we are saying that if there's going to be another sell-off in the same magnitude like last February, okay, then unless those levels that I did mention are not violated, then it's still a very, very positive outlook.
Okay, and also the next question from David asking, is there a high chance of recession in 2022?
I think we have a very good chance. Because there are many factors that is not working in our favor. You see, the Western central banks, okay, has all taken up the bazookas. They have launched not only a monetary policy by cutting interest rate to almost zero, okay, then they do QE, and both these two doesn't seem to do the work. They have to launch massive amount of fiscal policies, and right now the economy is wobbling again because the Delta variant is coming back again. Okay, so if the US consumers are not spending and producers are still having to struggle with finding workers and at the same time dealing with high costs of their input costs, then I think everything is going to come unglued. So there's a very good chance that we are likely to see softer economic performance going forward, especially into the last quarter of this year.
All right. Then, another request here from Robert asking, can you share again the link for this Sunday webinar?
Oh, yes. If you want, let me see if I can do that.
Yeah. And then maybe you copy the link. Okay, yep. Yes, we saw the link. Okay, good. The next page, will the market crash if the Fed tapers? Obviously,
whether they will taper, that's another open question. Okay, in my opinion, even if they taper, it will not be in the amount that the market wants to cause a massive collapse. Okay, because they can't. They need to keep on buying all these securities and mortgage-backed securities because they are trapped. All the central banks, especially the ECB, the BOJs, they are all trapped because right now they cannot afford to high interest rates. Because when they high interest rates, now you got to understand that the national debt in US is $28.7 trillion. If the high interest rate, every basis point increase in interest rate is going to add on to the burden of servicing those debts. Right now, they are paying something like $1 billion a month just to service the national debt. Can you imagine the cost of servicing those debt increases by even 1/4 point? Okay, will be too massive for them. It will cause the market to collapse. So they really cannot afford to do anything on the interest rate front. And taper, again, if they taper, it has to be in an amount that the market will take notice. If they're going to cut maybe out of the $120 billion in which they have to commit to buy all these securities every month, if they cut down, let's say, $100 billion, it's not impactful enough. It's got to be something drastic to cause a market to actually sell off big time. If there's going to be any sell-off, it's going to be a knee-jerk. Okay, eventually the market will have to bounce back up again because it's got to be in a number that will make you and me sit up. Okay.
Okay, looks like we have answered all the relevant questions. I will not take in all the questions that are talking about crypto and also precious metal and all this. Today's topic is more on US indices. If you have more questions on that, we can take on. But for now, I see all questions related to today's topic is answered. Okay, that's good. All right, Danny, is there anything you would like to add on before I jump to the next agenda?
Well, if you got any question that you have that you want answer from me, you can always find me on Sunday. Okay, do come to my webinar every Sunday at the same time. I just talk, about my views. I cover everything under the sky. So those questions that are not relevant to the topic today, you can always ask me on every Sunday.
Okay, good to hear that. Thanks, Daniel, for the wonderful sharing and also his insights on the upcoming view for the US and also our last quarter of this year. And also thanks everyone. Before that, Daniel, do you have anything to add on before we gonna end this session?
Yes, and for those who have wanting to attend my Sunday webinar, do check out my Facebook page in which I will update the details for the webinar on Saturday itself. My Facebook page is as www.facebook.com/Daniel Ang Traders with an S. So you can find me there or just search under Daniel Ang. And of course, I will appreciate if you can give Nicholas some feedback as to how I do this webinar for you tonight. And any comment will be most welcome. I will need to get your feedback because I want to improve myself. And all right. And I hope you guys all the best in the days and weeks forward.
Okay. And thanks, Daniel, and also everyone. Should you have any further queries, please feel free to drop us an email at futuresmarketing@kenanga.com.my. We appreciate you being here and hope that you enjoyed the webinar tonight. Please take a minute to rate our webinar and your feedback is highly appreciated. I have posted the feedback form link in the chat box itself. You can just click the link over there and just let us know what you think for tonight's webinar. All right, and also do remember to check out our Kenanga Futures nationwide campaign, Accelerate into the Futures. Prizes worth up to 50,000 ringgit to be ready to be won. And thank you once again for joining us tonight. And also always check out our event calendar for our futures event. And we hope to see you in our next event. Stay safe, everyone, and good night.
What are you clicking?
Click KenangaFutures.com.my, Malaysia's leading derivatives broker.